Hey, good morning, everyone. Good morning. Is anyone there? How's everybody?
Good morning, Professor.
Hi, good morning, Jaylin. How's the rest of the class? Huh? I see four people here, and let's see. Let me quickly check how many are in the forum. Looks like I have five people in the forum. Well, so hopefully more people will join um shortly. I see Sorav is having some connection problem, looks like. Alrighty, so uh, let's continue from where we left off last time. So in our is that the color that I picked? Okay. So we were talking about, basically, three types of logarithm, right? One, common log, right? Two, binary log, right? Three, natural log, right? So we talked about, what common log is, and the most important thing here is the fact that uh, when you take log of x to base 10, and if this happens to be something, if x happens to be uh, some powers of 10, right? So that means, basically that means, x is a number that is, some nth power of 10, right? Then you can bring down, right? You can bring down that n as if it is, some coefficient, right? And that's the uh, and that's the benefit of, that's the benefit of what log does, because that way, what does it mean? It means basically, it turns what used to be a power function. Look, this is like, previously, it's like z equals x to the y, x raised to y structure, right? This is something you have to, uh, you should not lose track of, right? But you turn it into a multiplicative function. You turn it into a multiplicative function, right? Once it is in multiplicative function, then we can solve, um, you see, now it is from the product power function. When it is power function, you cannot, it's hard to tell, it's hard to find, it's hard to solve for that y, the exponent. But once you turn it into a multiplicative structure, right? Now you can easily solve for y, because then what? Y is then, we can easily, z divided by x, right? So that's the takeaway. That's the main takeaway from using log. But again, last time we already talked about it, because there are limitations to what common log, limitations to what numbers the common log can take for log. Uh, in other words, it has to be numbers that are powers of 10. Mathematically, it doesn't have to be. It doesn't have, I mean, you can take any number, you can take common log of any number, you can take common log of, you can take binary log of any number. That's not impossible. But then the problem is, it's not difficult, it's not impossible, but it's not easy to figure out what would be the base 10 log of a number like, some number like, 13.627. I mean, the calculators can do that. The computers can calculate it. But for human brain, it's absolutely it's absolutely nuts to figure out what would be. I mean, think about it. That means that means basically uh, 10 to what? 10 raised to what will make it 13.627, right? Can any human brain easily, figure out what this is, right? What x will be? So that's one thing, and and besides, yeah, how do we uh, the numbers we want to take log of can be not only that, but also something like um, not only integers, but real numbers with decimal places, and the decimals that can go on forever, right? Which are called irrational numbers, right? The decimal where the decimals go almost infinitely, and we are really limited. We are really limited in taking log of such numbers when we use only common log or binary log, and that's why we need natural log, right? So natural log, in the last class I said, is a log using Euler's number as the base, right? Also, so natural log of x can be written also as this, and of course natural n would stand for natural. So the big question was then, what is Euler's number? So Euler, and I said, Euler was a Swiss, a German mathematician in the 17th century, and he discovered, this number. So to explain what Euler's number is, suppose we have, let's say, we all know what this is, right? Right? We all know what this is. APR is annual, of course, annual interest rate, right? Annual percentage. I have, let's say, 8 people, and I also have, let's see, I have 10 here. I mean 9. Okay, so almost everyone is here. Okay, good. So we know APR is always something like 3%, 6%, or 10%, something like that. But just to make it simple, we'll assume, let's say, APR is 100%. And APR divided by M is the periodic rate, right? Periodic rate. Um, so we're gonna, and normally we normally M is 1, 2, 4, 12, 52, 365. But is that, annual, semi-annual, quarterly, monthly, weekly, daily? But is that all? I told you, previously that it can be normally, for all practical purposes, they don't use anything above 365. Generally, what is commonly used is, right? Weekly, that isn't even used. But I told you, there is no just for mathematical purposes and for research purposes, there is no reason it will stop only at daily compounding. It can be, by the hour, which is then 365 times 24, and it can be even by the minute, then 60, and then it can be even by the second, then squared, right? 60 squared. And even, then the question is, what is the ultimate compounding frequency? Think about it. First of all, as you increase this m, as you increase the compounding frequency, it's almost like breaking up time or splitting time into a very, very, very small fragment. Isn't that right? Mm-hmm. You are, by using 365 or m, it's like splitting a year into 365 fragments. I mean, if we do, if we use compounding by the second, right? If we use the compounding by the second, it's really, fragmenting the time, splitting the time, 1 year, into very, very, very small, fine fragments. And think about it. The more, if you can observe, the price movement of the stock in the market, right? Generally, you observe it by the hour, by the minute. I mean, on Yahoo Finance, you can observe, the movement by the minute, right? Even by the minute. But sometimes there's trading. It's not always, the trading doesn't happen, by the minute. I mean, sometimes there's no trading, no transaction for 30 minutes, and then suddenly, or sometimes the trading happens, like trading happens, multiple times, even per second. I mean, in other words, what I'm saying is the frequency of trading is actually, it can be continuous, right? In other words, the time as we understand is a discrete unit, by discrete unit. We perceive time by minutes, seconds, minutes, hours, day, month, week, month, year, quarters, years. So they are all time. Time is as if they exist in discrete units, and that's the way we perceive it. But in reality, is time really in discrete units? Time doesn't exist in discrete units. Time by itself is a continuous flow, right? So then think about it. When the market transaction happens by every nanosecond, right? Nanosecond means 1 billionth of a second. I mean, think about it. Trading can happen um, just irregularly. I mean, it doesn't have to be. It doesn't happen, necessarily by the minute. It happens, at erratically at any point. And there can be thousands of tradings that can, happen even during the same second. So actually, to track all those, to plot all those movements, right? Plotting it by the minute is not even enough. You will have to break time into a more, smaller, finer fragments or segments, right? And then if we can do that, breaking time into a smaller and smaller units or fragments, and if we plot the movement of the stock price, then it will become a smooth line, right? In other words, if we, what I'm saying is, if we plot the if we plot the movement of the stock price by the hour, it will look probably, by the hour. It will look like, it will look like this. But if we break it into a smaller, I mean, by the minute, if we track it by the minute, it will look more like this, right? But if we track it by smaller segment of time, right? Very fine segment of the time, it will eventually look more like, it will be a very smooth, right? It will be a fine line, a very smooth line, right? Very smooth curve. Uh, so that's why we want to break time into a smaller segment, right? Then we can, we can emulate the uh, the smooth, fluidity or the smooth curvature of the actual movement of the stock price. I mean, it won't be really perfect smooth curve, but at least we can smooth it out more and more. We can smooth out all these jagged kinks, right? We'll be able to smooth out the jagged kinks in the plot, right? So now I kind of digressed a little too much, but the question was, so what will be the ultimate? What will be the ultimate n? What will be the ultimate frequency, compounding frequency? The ultimate compounding frequency is, of course, what if it goes to infinity, right? Infinity. If n goes to infinity. And you might wonder why 1? 1 is 100%. 1 is 100%. And that means, if your investment, if your principal, right, if it grows by 100% during a year, right, the next year it will be doubled, right? Future value will be doubled. But ignore this for a while. Ignore this for a while. Principal for a while. Ignore it. So of course, in reality, the interest rate is not 100%, but we'll just assume 100%. And if it is 1 later, it's not difficult to replace it with any real interest rate, with any realistic interest rate, right? We'll just use 1 because it makes it a lot simpler, right? It makes it a lot simpler. Now think about it. And if it goes to infinity, then this becomes 1 plus 1 over infinity raised to infinity. Okay, then our question is, what is this number going to be? What do you think? What do you think this is going to be? 1 over infinity.
It would be 1.
1? Why would 1? It will be only possible if it is 1 over 1. I mean, if you're dividing 1 by anything that if you want it to be 1, you will have to divide it by the same number.
It's infinity.
What did you say?
It's infinity.
Infinity? Infinity? No,
Yeah.
no. How can it be infinity? What is an infinity? Infinity is an infinitely large number. Isn't it right? Infinity is an infinitely large number.
But didn't you say 1 times anything itself?
No. Does it look like 1 times?
Oh, it's divided.
Yeah, you're dividing 1 by an infinitely large number. And logically, what is it going to be? I'm using the whiteboard and I'm putting it, I'm sharing the screen, so you should be able to you should be able to see it. And if you see it, right? I didn't say, and I didn't write 1 times infinity. It's 1 divided by infinity. What should it be?
Infinity?
What?
Infinity.
Again, are you not listening? Someone said infinity and he got it wrong, and you were not listening. You infinity. What is an infinity? Infinity is an infinitely large quantity.
So is it like
You're
undefined or
dividing 1
something?
by an infinitely large quantity. So
It's,
logically, what should it be?
Undefined or
Yeah, good. It is undefined, or I mean, actually, undefined is undefined is anything divided by 0. That's undefined. You cannot do that. It's undefined. This is actually, it is, you can say it is undefined, but it is. We know. Think about it. You're dividing any number. You're dividing any number by an infinitely large number. It will be. Think about it. You divide 1 by 100, it becomes 0.01. Divide 1 by 1 million, it's going to be 0.0000006 zeros and 1. Divide 1 by 1 billion, it becomes 0.0009 zeros and 1. You divide 1 by any number, 1 by,
The zero? The zero?
it won't, yeah, but the logic is, yeah, you're close, but it's not going to be exactly 0, but it's going to be close to 0, right? It will be something almost equal to 0, but not exactly 0. It's called asymptotically 0. It will approach but never touch the, it will approach 0, but it will never be 0, right? Yeah, so it's either undefined or, close to 0. Who said undefined? Or close to, who said undefined?
Lewis?
Lewis?
Yeah.
Okay. Was it also you who said 0?
No, that was not me.
Who said 0?
I said 0. Eric.
What's your name?
Eric.
Eric. Okay, Eric. So you both got 0.5. That wasn't exact answer. That wasn't exactly correct answer, but the logic, at least you got the logic. You guys got the logic, right? You guys were thinking logically. So you got 0.5. Yeah, it will become close to 0. So it's like, it's going to be like 0.000000000, 0.000, infinitely 0, infinitely 0, infinitely 0, infinitely 0, and 1. Something like that. It's going to be something like that, right? Now, this poses a problem. Why? If this thing is completely 0, if this was completely 0, then we have no problem. This problem is already solved. Isn't it right? If this thing is completely 0, right, then it's just 1 raised to infinity. 1 raised to infinity will be just 1. Isn't it right? 1 times 1 times 1 times 1 times infinitely times 1. It will still be 1. So we will have an easy answer. But now we don't have easy answer because this is not exactly 1. It's slightly greater than 1. Slightly greater than 1. And if you raise it to infinity, what's it going to be? If it is 1, it's just going to be 1. But it's just slightly greater than 1. And then Euler found this number, and it was like 2.178 something. It goes on forever. Okay, but it approaches, something like this. So that's called Euler's number, and this is the basis of natural law. But before we go on with the natural law, let's do this exercise so that you will know. Open this file, right? You have it in front of you. Open this file. And when you have that file, click this bottom tab. Okay, click this bottom tab. That says EAR or APY. And let's go to column I. Are you all there? Are you guys all there?
I am, yep.
Okay, good. So column I, the label says 1 plus 1 over m raised to m. So what is this? We know what this is. This is basically the compounding factor, the multiplier, right? Right, we know what it is. Okay, this is basically that's my key pencil, crayon. It's like crayon. So let me undo that. But we know what this is. It's p times in compounding formula, right? APR over m raised to n. Okay. This is what we already know. This is, okay, where we assume t is 1, okay? Where if it is 1 year, right, we don't have to bother with. So just, what's going to be this multiplier or compounding factor, right? Multiplier or the what's going to happen to this? So that's called, compounding factor, right? So as we increase the compounding frequency, what's going to happen to that compounding factor, right? And we know, we just do exactly what it is, say, 1 plus 1 over m, this is m, right, raised to n, hit enter. Of course, that means, if compounding is, what does this mean? Compounding is annual, and if your interest is 100%, you're going to double your money. Your future value will be doubled at the end of the year. And then if it is semi-annual, we just copy and drag it all the way down. Copy and drag it all the way down. And we know that as the compounding frequency goes up, as m increases, the future value will be greater. Yeah, by the factor of these numbers. And by annual compounding, it's going to be 2.714567. It looks like, first, it looks like, we can double our money if the interest rate is, 100% a year later. And since compounding frequency, higher compounding frequency will result in a greater future value, it looks like we will be able to even triple or quadruple, right? In a year, even within a year. Of course, over a long time, we can do that. Even within a year, if the compounding frequency just increases, then we can even triple or quadruple our money even within a year. No, even if we increase our compounding frequency, right, to 1,000, it doesn't increase that much. From after you hit, 365, after daily compounding, right, that's 2.718, 2.714. Even if you increase it to 10,000, it does 2.718. It doesn't increase that much. And this is 100,000. Oh no, 1 million. 1 million. Even if the compounding frequency is 1 million, it doesn't increase much from 2.718. 2.718 to, right? It doesn't increase that much. Even, that's 10 million, this must be 1 billion, 36990, so 1 billion. Even if you increase it to 1 billion, right? It doesn't deviate that much from that 2.718 to 8. And then what if it is increased to infinity? If it is increased to infinity, we will have to use exponential function, right? Which is exp, which is actually Euler's number. This is the raising. This is basically, show you 1 year exponential function. 1 year for 1 year. Look, it isn't that different. I mean, it does. It just approaches and just gravitates towards or centers around. It just centers around 2.7181, right? 2.718. So in other words, what I did here is basically Euler's number raised to 1. In other words, Euler's number itself. Euler's number itself, right? So exponential function for 1 year, right? So then, what do we conclude from here? The conclusion is Euler's number is an irrational number. In other words, it goes on forever. Irrational number. and it is it's the basis of it's the base of the natural log, and it is the number that is stretched, or when when you raise, a number slightly greater than 1, when you raise it to infinity, this is what you get in the limit, right? It cannot be stretched. And another takeaway is that it is think about it. It can the lowest number that you can raise to power. You think what do you think it is? Lowest number, smallest number you can use as the base of the that you can raise to power. The smallest number that you can raise to power. You think it is 2, right? Why? Because one cannot be raised to power. One cannot be raised to power, right? Because no matter what you do to 1, 2.718. Okay, this was wrong. Because no matter what you do to 1, right? 1 raised to whatever is still 1. So 1 cannot be used as the base of any log, or it cannot be used for raising. But then, so the next thing is 2. But think about it. These are only integers, right? They are only integers. But between 1 and 2, how many numbers are there? There are infinitely large amount of numbers between the two. Isn't that right? 1.0000000000001 and 1.9999999. I mean, think about it. Between 1 and 2, there is just uncountable amount of numbers, which are called real numbers, right? So basically, then what should be the smallest number? I mean, the number that is slightly greater than 1, right? Right? 1.00, infinitely 0, infinitely 0, 1, right? This can be used the base of the power. And then, I mean, extending this logic, right? Because of this continuum, right? Infinite continuum of numbers between 1 and 2, and between any integer, there's an infinite continuum of numbers, right? So if you, that's the reason for using natural log, because it can be the base for the log, to take log of any number, because it's a continuous. Basically, it's a continuous number, and it's based on the number that is just slightly greater than 1. Okay, that is the theoretical, mathematical theory behind it, the theoretical background behind it, and understanding that, then we know why natural law. I mean, the basic takeaway is this: when we express something in log, right? Whatever, if this is natural log of x to the n, then we can rewrite it as n times natural log of n. This is why, because this helps us to turn a power function into a multiplicative function. And then we can solve for, in other words, we can turn this is power function, we can turn it into a multiplicative function, and we can solve for that n, right? We can solve this for n, right? We can solve for n. So now that gives us an idea. So again, think about it. We had basically FV over P, from the base function, right? From the 1 plus r raised to n, right? And then it is, since this is, z equals x to the y structure, this is like z equals x raised to y structure, then if we take the natural log on both sides, right? We take natural log because we don't know what this number will be. It may not be conveniently powers of 10. This either, the right-hand side either. It cannot be, it may not be conveniently powers of 10. So we take the natural log on both sides. And then by taking the natural log, natural log of 1 plus r raised to n. And then using that property of log, right? This becomes, then n times natural log of 1 plus r. Then we can solve for n now. We can solve for n. Now it is z equals x times y structure, right? Now it is, now it's z equals x times y structure. So finding x.
So now you could divide y.
Right. The z divided by y, that's going to be x. So n will be, let me change that. N will be natural log of the, I'll just call it FV over P, natural log of 1 plus r. And calculating the natural log is done by Excel. So we have the formula now, right? So this was more involved than anything else because you needed, the understanding of log and natural log and Euler's number, right? It took more, clearly, but then it is important because most teachers, most professors, most textbooks just give you this formula, just throw this formula at you and just tell you memorize it. Hardly, I haven't seen anybody who actually explains why it is derived. Of course, it takes a lot of time. And if the students are not prepared in math, and if you're taking finance, then it has already been assumed that you have taken all the math prerequisites, so you would understand this. Now, but the reality at BMCC is that you cannot assume the students have done all the math prerequisites. So you have to explain all of this. And in other schools, four-year schools, math prerequisites must have been met. Then you don't have to explain this. You can just throw the formula at you, and you just understand it on your own. why this formula, why we end up with this formula, you figure it out on your own, right? If you have the math background, you have the math prerequisite, you can figure it out on your own. And they don't, and there are too many things to cover, and with the limited time, there is no way you can explain all this. But I do, because here at BMCC, hardly, there is the math prerequisite is below this, so you can't assume even half the class have the math background for this, not even half. So even if it takes a lot of time, I have to do this. But the point is, these formulas are all correlated with each other. It's not like separate things. And if you just tell the students, yeah, this is the formula for n, memorize this. This is the formula for r, memorize this. No, that way, it's just rote memory doesn't last long. Okay, so this is how formula for n is derived. Then now we are ready to solve. We are ready to solve, right? We are ready to solve, actually. So we go to now this. Let's go to row 19. It's not a difficult thing. We know it's going to be 5. It should be 5. But let's see. If you get 5, that the formula checks out. The formula is natural log of FV over P, okay, divided by natural log of 1 plus R, close parenthesis. And I need you to do this together, right? Hit enter, you get 5, right? Then next, this one is more complicated because the compounding frequency is quarterly. So for that, I would like to, do it this way. I told you, the simpler the model, the better it is, right? Easier to, if ever there's an error, it's easier to fix. So all you need is just 2 more columns for periodic rate R and N, actual number of compounding. So first, we will need the periodic rate, which is simply APR divided by M. Okay, and then we will get 20, the 20 quarters, actual number of compounding. All you need to do is natural log of FV over P by natural log of 1 plus R. Now think about it, that R is the quarterly rate, and if we work with quarterly rate, if we put quarterly rate, we'll get quarters. It's only natural. We'll get quarters, right? So you'll get 20 quarters. But the question was asking for time in years. Then what should you do? You'll have to convert it into years, which is just n divided by m, which is in C26. Oh, D26, I'm sorry, D26. D26. You go, you get 5. So everyone got the same result? Then let's do it this way. Let's try, this will make it more complicated. Natural log of FV over P divided by natural log of, this is APR, right? 1 plus, I'm sorry, I forgot to put 1 plus APR. Now, we are, the compounding frequency is quarterly, right? So we'll have to divide it by m, which is in D21. Okay, and then think about it. So we made, adjustment. But if you hit enter, what did I say? If you use quarterly rate, you'll get quarters. So what you will get here is 20 quarters. If you just stop here, then you're wrong. Why? Because the problem was, look, the label is, what is the label saying? Years, time in years. If you leave it like this, you get 0. Because you're saying 20, it's like you're saying it's going to take 20 years. So we need to make adjustment. And this whole thing is quarters, right? So this whole thing, you'll need to divide it by n, which is what? The whole thing. So put whole thing in the parentheses and divide it by m, which is in D21. And enter, you'll get 5. All right? So everyone got this? Everyone is okay with this?
Yep, that makes sense.
Okay, all right, good, good. So it's 11:55 and the right time to take a break. So let's take a 10-minute break and reconvene at 1:05. Okay, I'll just leave this in formula view. I'll leave this in. All right, we're back. So now we're moving on to, we're done with the single cash flow model, and we're moving on to the multiple cash flow model. So what is multiple cash flow? What is single cash flow model first? I mean, what you have done so far, everything that we've done so far is single cash flow model. In other words, the base formula, the future value formula, right? Whether it is future value or present value, right? Basically, there is only a single cash flow. Excuse me. Well, what I mean by that is that you put your, you make a deposit, 10K, deposit of 10K, and, interest rate is something, 10% or 10%, and 5 years, right? And then 5 years later, you'll get, let's say, 26K or something, right? This deposit of 10K is a single cash outflow from you. It's a cash outflow. Right? Cash outflow is usually expressed as negative. And then 5 years later or 10 years later, you will get a cash inflow. You'll get a cash inflow of 26K. Right? And this is cash inflow. So there is a single cash outflow and single cash inflow, right? Single cash outflow versus single cash inflow, hence called the single cash flow model. Single cash flow model, right? However, it's not always like that. For example, when you lend money, suppose you lend $1 million at 10% interest rate for 10 years or for 30 years, right? Let's say 10 years. If you're the lender, if you're lending $1 million, are you going to wait 10 years for the borrower to come up with the future value 10 years later? Are you going to wait 10 years? Yeah, tell me. I mean, this is not a rhetorical question. I'm asking you, if you're the lender and you lended $1 million for 10 years, are you going to wait 10 years for the borrower to come up with the future value, the full future value 10 years later? Anyone? Are you guys there? Excuse me. Anyone there?
Yeah.
Okay, Louis, I can always count on you. If you were the lender, are you gonna just lend $1 million for 10 years and just wait 10 years? Huh? No, it's not. It's not gonna. It's highly unlikely. I mean, nobody's gonna lend $1 million and just wait 10 years for the borrower to come up with the future value, right? 10 years later. In other words, in a lending situation, the reality is not like, number one. The reality is not like this. Okay, it's not like this. Of course, this is number one is a case of the stock. If you put your money 10K in the stock and just leave it for 10 years, This is going to be, and if the average return on the stock is 10%, it's going to be like this, right? But that can be the case. But if you're lending $1 million, and this is not gonna happen. Yeah. So what do? If you're lending $1 million, actually the payment starts from the next month already. No one just waits, right? 10 years. The payment will start from the next month, and it's going to be in monthly installment, right? Principal and interest is repaid little by little by monthly installments, right? For 10 years. So there will be 120 payments, right? For 10,000. I mean, for $1 million that you loaned out. So in reality, think about it. Those 120 over 10 years, if there are monthly payments, there will be 120 monthly payments, right? 120 monthly payments. So the reality is, there will be a multiple cash flow, right? When you make a loan of 1 million, that's a single cash flow, your single cash outflow, but then there will be 120 cash inflows, right? So the reality is much like, the reality is different. So let's take a look at an example. Let's take a look at this example. So suppose you are preparing, let's say you are preparing for graduate school to go, so you want to go to graduate school in 5 years. So you want to go to this MBA program. MBA program is 2 years. I mean, if you take full load, you can finish it in 2 years. But it's gonna cost money, and for 2 years, it's gonna cost about 60K. And let's say this is CUNY price, CUNY tuition, right? So Ivy League schools would cost more. It would cost like $50,000 a year. So for 2 years, it would cost about $100,000 base. But anyway, let's say it will cost 60K. So how do you how are you going to fund it? That means you will need to have 60K in at the end of year 5, right? So to prepare for that, you get a part-time job and you save $800 every month. Okay, it has to be a constant amount. It shouldn't be. It cannot be irregular amount. It's not like 1 month 800, another month 750. No, another month 600. No. You cannot do it this way. If you want to accumulate it to something, you have to make a regular deposit at regular interval. So every month, at the end of the month, $800. And if the current APR is 6%, right? Are we going to 5 years later? In 5 years, are we going to accumulate 60K? Let's see if it's gonna if you are gonna meet that the target. So it's going to be like this. The timeline is, of course, end of this timeline is, 60 month. Month 60, this is 59, 58. Starting from time 0, first month, second month. So third month, you're making a deposit every month, 800 here, and another 800 here. And another 800 here. But since APR is 6%, 6% APR means what? What is the periodic rate then? Anyone?
So for 6%, and then you would have to multiply by
Why multiply? Why multiply?
So
Why
you
do you
need to
say
find-
multiply? Huh?
Give me 1 second. Because you got to find the periodic rate,
Right, right.
and then what would the periodic rate be? I'm a little lost after that. I don't know what number I have to multiply by.
Why do you multiply? I mean, what is periodic rate? What is R?
1 second.
Yeah. So R is, you'll have to, divide
Oh,
APR by M.
divide. Okay. And then M is
And M is what? It's monthly. We are making monthly deposits.
so it's 12.
Yes, then what would be
So
R?
6 divided by 12 is 6 divided by 12 is 0.5.
Yeah, it will be 0.5,
Nice.
of course. Right? 0.5%. But then, and who was this?
Lewis.
Lewis. Okay. You got another 0.5. So think about it. The first deposit will earn, right? Because you put it at the end of your at the end of the first month. Come on, it's gonna, by the end of the this time period, by the end of 60 months, right? It's gonna become what? It's, by this time, it's gonna become 800 times 1.005 raised to 59. Isn't that right? To the 59th power. Isn't that right? Because we're not starting from time 0, we're starting from time 1, right? And then the second deposit, by the end of this timeline, is going to be right? 800 times 1.05, and so on. I mean, you know what this is. You know what this is leading to, right? So this is going to be a very long example. I mean, not long example, but if you want to do it like this, it's going to take a lot of time. So let's take a look at a smaller example, small scale example. So here, suppose you are making $1,000 deposit at the end of every year for 5 years. Then what's going to be the future value of all these deposits? Now you get the idea. The first deposit, $1,000 first deposit will earn interest, 20 if interest rate is 20% a year, right? 1.2 raised to 4 because it's going to be, right, compounded 4 times, 4 years, right? Compounded 4 times. Second deposit will be compounded 3 times. Third deposit will be compounded 2 times. Fourth, and the last one will not earn any interest because at the end of year 5, think about it. That's not even a deposit. You technically, I mean, to technically qualify as deposit, you dip it in the bank, but you take it out right away. Right? You just dip it into the bank and just, take it out right away. So you're not going to earn any interest. So by the end of year 5, it's going to be like all of those future values are going to be like that. And then if you add them up, if you add them up, it's going to be 7,441.60. Okay. That makes sense. Well, again, we can't do it for, I mean, we could do it like this. We can visualize it, and just for illustrative purpose, we can do it like this because we have only 5 payments, right? But if it is like our example, it's not impossible, but it's
with 60 payments,
it's
it's a lot
very
harder.
tedious. Yeah, it's going to be, you have to do 60 of them like that. So obviously we need a formula, right? How we handle this, something like this. So the formula is this. That's what? Future value, why is it A? Future value of annuity is payment times, payment is the deposit, the same thing. 1 plus r raised to n minus 1 over r. But then what is annuity? This is exactly what annuity is. Annuity is the regular amount at regular interval. So regular amount of payment or deposit. And I told you payment and deposit are the same thing. Right? Deposit or payment is the same thing. If you are the lender, right, there will be a deposit at the end of every month. If you are the borrower, then if you are the borrower, either way. I mean, if you're the borrower will make payment every month, right, at the end of every month. So it's the same thing. There is no, but actually, no symbol for deposit. It's just the same thing, payment. Okay, the symbol for deposit or payment is just payment, PMT. So that's called annuity, regular amount at regular interval, right? It's called annuity. Annuity sounds like something annual. No, it's not only annual. It can be quarterly, it can be monthly, it can be weekly, it can be even daily. Okay, what matters is the regularity. It has to be the regular amount at regular interval. Okay, now what is then this FVAD subscript D? That's called annuity due. Annuity due is the similar scenario, but the payment is made at time 0 at the beginning of the period, not at the end, right? So the same scenario, but you're making the deposit at the beginning of the year. So then you're going to have, at the end of the 5 years, you're going to have the first deposit will have interest 5 times compounded, right? Because you're making the deposit at time 0. The second deposit will have earned interest 4 times compounded, and so on. So even the last deposit will have earned interest once. Okay? So then what is the difference between the, how can you summarize the difference between ordinary annuity and annuity due? This is called ordinary annuity, right? Ordinary annuity is basically the default, right? It's called ordinary because it's the default. So that means unless otherwise specified, unless it is specifically told that this is, annuity due, by default, it is ordinary. Okay? By default, you assume ordinary annuity. So then the difference between the two is, now think about it. The payment is $5,000 here. Interest rate is 10%, so that's the difference. But ignore that difference. Just assume that they have the same payment in both examples, same payments, same interest rate. Then what's the difference? The first payment, the only difference is that each deposit will have one more compounding, right? Future annuity due will have one more compounding than ordinary annuity. Okay? So that, with that in mind, now let's do this. Let's go to Excel file and click on the multiple cash flow bottom tab. Okay, multiple cash flow. So here, this is exactly our example. You're making a deposit of $800 every month, right? Monthly, right? That means every month. APR is 6%, time 5 years. What's going to be the future value of that annuity? So we're going to make the model, we're going to use simpler model, right? So we're going to, first, find the periodic rate, which is, 6% divided by 12. That will give you 0.5. And n, actual number of compounding, there will be, it's 5 years, monthly, so 5 times 12, right? Is 60. That 60. And applying the formula, and what was the formula? The formula is this, right? So it's going to be future value of annuity is equal to payment times, open parenthesis, and open one more, 1 plus R raised to n minus 1, close parenthesis, divided by R. Okay? Did you guys do that? Are you guys up to this point?
Yeah.
Okay, then hit enter and we'll see. All right, so this is what you got. But this is only the first hurdle. Now think about it. This isn't the question. It's only the first. You just clear the first hurdle. Why? Just don't say, hooray, I got it. No, you just made it through the first hurdle. Why? Question was what? How much do you need to fund your graduate program, fund your MBA program for 2 years? How much do you need? What was the target future value? You forgot?
60,000, I believe.
Right, 60,000. Yes, you need 60,000. So do we have we satisfied or have we met that goal? Have we met that goal? Have we met that goal?
No, we haven't. No.
No, we haven't. So obviously we have to try out. We have to try out alternatives. In other words, alternative strategies. I mean, 800 is not enough. So three possible alternative scenarios is you increase.
So we can
You
wait.
increase monthly deposit by $60, or you find a bank that pays superior interest rate, right?
Yep.
Like
Yep.
8%. You might say, it's just 2% more. I mean, how much it will make some difference, but in banking industry, 1% difference, it's a significant difference, right? I will put my money to a bank. I mean, if I have $1 million, I will put it to a bank that pays at least 1% more interest than the one that pays 1% less. So it's not easy to find that pays 2% higher. Or another strategy is extend your timeline to 6 years. Well, why do you have to go to graduate school in 5 years? Exactly. I mean, how about 6 years? I mean, you work one more year and accumulate more fund. It's possible, but those different strategies can be easily compared. It can be easily compared.
I have a question.
Yeah. Before you just hold on to that.
Go ahead.
It can be all of those different strategies can be scenarios can be easily compared by highlighting those, selecting those three cells all together and dragging it down, and then we'll see. We get the result instantaneously. Yes. What was your question?
Could we also try to find for like a bank that has a higher rate of compounding, like it compounds more than just
Oh, you mean M, higher M?
Yeah.
Yeah, it's not entirely impossible, but generally they don't. I mean, there may be a bank that has 365, right? Compounding at 365, but they generally don't do that. They do it. They use daily compounding on their credit card balance, right? Credit card companies, right? They actually your interest on the credit card is actually compounded on daily basis. Okay,
Oh,
they
okay,
are
okay.
they're already charging already, but for their own sake, they will use higher compounding frequency for their own sake, right?
That makes
But
sense.
this is the interest that they will pay out to you. So, and once again, banking is a very competitive industry. So if on average they all pay 6%, um, you unless it is a new bank, newly established bank, and that needs to really market harder to gain their to establish their presence in the industry. Unless it is like that, they generally don't pay, give uh, preferential conditions to the. I mean, if it is a well-known, well-established bank, they don't have to pay a high interest rate, right? I've been telling you, the lenders, um, if you are the borrower, if you have an excellent credit score, you don't have to pay a high interest, right? The same, just the same. But anyway, we can evaluate all four different strategies and four different scenarios, and you can tell, 860, we meet that, we meet our target, but we overshot a little. We overshot a little by $2. It's not a big deal, but you would like to. You might wonder, is there any way we can nail exactly uh, the payment that? So the exact payment cannot be too much different from 860. It would be slightly lower than 260, don't you think? It would be slightly low because when we put 860, then we overshot by $2. So It will be slightly lower than this. Is there a way we can nail exact payment? Yes, there's a way we can do that. That's the next topic. And then if it is annuity due, if we use annuity due, right? How much difference is it gonna make? It will make some difference. Let's see. But what did I say? What did I tell you? What's the difference between ordinary annuity and annuity due? What did I tell you? Does anyone remember? What did I say? Seems like no one. I have only how many people now? 6 people. And where's the rest of the? The people who have fallen out, they will all get, late. They will all get, a point for late. This is,
So annuity, the regular annuity is at the beginning, but annuity due is at the end of the period.
No.
No, it's the
It's
other
the
way
other
around.
way
Yeah, I'm
around.
sorry. Yeah, the other way around.
But I said the difference between the two is what? The difference between the two is one more compounding. Think about it.
One more
The
compound.
first deposit in ordinary annuity, it got compounded 4 times. But the annuity due, the first deposit, it got compounded 5 times. And every deposit gets compounded 1 more time.
Oh, okay,
So
that
the
makes sense.
difference between the two is 1 more compounding. That means we can recycle this result. We can recycle ordinary annuity and give it 1 more compounding. Give it 1 more compounding. Okay? And then that's annuity due. Okay? This way, yeah, it's better, but still we're about $4,000 short. It's better. But we have already met our goal. We're still like $800 short. If we extend it to 6 years, we'll have plenty of money, right, to fund it, right? Either way. So next, we're gonna figure out how to nail the exact payment, but we're out of time already. We're out of time, so I'll have to call it a day. So that's it for the day. Any questions? Any questions so far? Alrighty, if you have no further questions, I'll call it a day. Have a great, I will stop recording. Have a great day, everyone, and see you on Thursday. Okay?
Good day, everybody. Bye.
Professor.
All right, take care. Take care, everyone.